More than $2 trillion changed direction in less than a year. Not through emergency announcements, not through press conferences, not through headlines scrolling across financial news screens. It happened quietly. Capital didn't vanish, it relocated. And it did so under the stewardship of the largest asset manager on the planet, an institution that oversees more money than the GDP of most nations. To the casual observer, nothing looked unusual. Markets continued functioning, stocks fluctuated. Commentators debated inflation, interest rates, and elections. But beneath the surface, something meaningful was already in motion. This is how major financial transitions begin. They don't arrive with spectacle. They arrive buried in filings, embedded in balance sheets, visible only to those willing to look past noise and into structure. That's why the most important financial information is almost always the least dramatic. It shows up in patterns, not proclamations. And this pattern has appeared before, several times. Each time, the sequence was nearly identical. Large institutions adjusted first. Public confidence remained intact. Then, months later, consequences emerged. Retail investors discovered the risk only after positioning windows had closed. The defining feature wasn't secrecy. The information was public. It simply wasn't emphasized. This is not a story about panic. It's a story about risk management. When capital at scale begins moving across borders, currencies, and asset classes simultaneously, it reflects something deeper than market sentiment. It reflects probability. Large institutions do not make decisions based on opinions. They operate through models, systems designed to test thousands of economic scenarios, evaluate structural weaknesses, and assign risk weights to future outcomes. When those models begin producing similar conclusions across multiple dimensions, action follows. Not discussion, not reassurance, action. And when trillions move, they leave footprints. In late 2024, regulatory disclosures revealed an unusual reshaping of portfolios by several major financial institutions. The most striking changes weren't tactical trades, they were structural reallocations. Exposure to domestic government debt declined, holdings in local equities were reduced, corporate credit positions were scaled back. At the same time, capital flowed outward. Funds were redirected into infrastructure projects outside the United States. Equity exposure increased across Asia. Sovereign debt in developing economies attracted new inflows. Commodity-linked instruments and precious metals gained prominence. Real estate in select foreign markets absorbed additional capital. This was not a minor rebalance. It was a broad-based shift away from concentration. And it happened without explanation. Institutions rarely explain defensive positioning in real time. Doing so would defeat its purpose. Instead, they rely on silence and execution. This behavior isn't new. It's part of an established institutional playbook. When risk probabilities rise beyond acceptable thresholds, capital doesn't wait for confirmation. It moves preemptively. History makes this clear. In the mid-2000s, several major financial firms quietly reduced exposure to housing-linked assets long before the global financial crisis became visible. Their internal models identified structural imbalances, while public narratives remained optimistic. Years earlier, before the European sovereign debt crisis dominated headlines, large banks and funds began trimming exposure to vulnerable government bonds. Those moves were recorded but largely ignored. Even further back, prior to the Great Depression, prominent financial families and institutions systematically reduced equity exposure while markets continued rising. Public confidence remained high until it didn't. The lesson across all these periods is consistent. Institutional awareness precedes public awareness. This is not because institutions are more intelligent. It's because they operate differently. They have access to broader data sets. They employ dedicated risk teams. Their decision-making frameworks are governed by probability, not emotion. Most importantly, they have a fiduciary obligation to protect capital first. That obligation changes behavior. While individuals often seek validation, institutions seek survivability, and survivability depends on preparation. When institutions move capital across borders, it's rarely because they expect immediate collapse. It's because they see asymmetry, more downside risk than upside reward. They don't need certainty, they need probability. If the probability of unfavorable outcomes rises high enough, even if those outcomes are years away, the rational response is to reduce exposure. That is what makes the current shift important, not because it guarantees a crisis, but because it signals that the risk landscape has changed. And when risk landscapes change, those who recognize it early retain flexibility. Those who don't are forced to react later under pressure. The question is not whether markets will fluctuate, they always do. The question is whether this quiet movement represents the early phase of a larger structural transition. History suggests that when multiple institutions independently reach similar conclusions, it's worth paying attention. Not because they are infallible, but because they are methodical. And methodical behavior at scale tends to precede meaningful change. Every major financial disruption is remembered for its collapse. Very few are remembered for their warning signs. That's because the warning signs don't feel dramatic when they appear. They feel routine, mundane, easy to dismiss. But when viewed in hindsight, those signals are unmistakable. Consider how financial stress actually develops. It rarely begins with panic, it begins with imbalance. Prices drift away from fundamentals, debt grows faster than income, leverage increases, margins thin. Eventually, the system becomes sensitive, vulnerable to shocks that would have been manageable under healthier conditions. Institutions monitor these dynamics continuously. In the mid-2000s, sophisticated risk models began identifying cracks in the housing market. Default correlations were rising, loan quality was deteriorating. Price appreciation depended increasingly on leverage rather than income growth. Public narratives remained optimistic. Home ownership was celebrated, credit was accessible, media reinforced confidence. But beneath the surface, positioning was changing. Large firms didn't issue warnings. They didn't predict a collapse publicly. They adjusted exposure. By the time the crisis became visible, those adjustments had already occurred. The same pattern unfolded during the European debt crisis. Years before sovereign yields spiked, major financial institutions quietly reduced holdings in the most vulnerable government bonds. Those changes appeared in quarterly disclosures, not headlines. When the crisis finally surfaced, retail investors absorbed the impact. These episodes weren't identical in cause or scale, but they shared a structure. Early detection, quiet repositioning, delayed recognition, asymmetric consequences. That structure is not accidental. It's a function of how information moves through financial systems. Institutions don't wait for consensus. They act when models indicate elevated risk. Retail investors, by contrast, often wait for confirmation. By the time confirmation arrives, pricing has already adjusted. This difference in timing is where wealth transfer occurs, not because institutions are malicious, but because they are early. Timing, not intelligence, is the advantage. That advantage becomes especially pronounced when multiple risk factors converge simultaneously. Isolated risks are manageable. Converging risks are transformative. When debt levels rise alongside demographic pressures, currency shifts, and policy constraints, the system becomes less resilient. That's when institutions reduce exposure, not because collapse is guaranteed, but because flexibility becomes valuable. Flexibility allows adaptation. During periods of transition, the most valuable asset is optionality, the ability to move, adjust, and respond. Concentrated exposure limits optionality. That's why institutional portfolios prioritize diversification across geography, currency, and asset type when uncertainty rises. It's not about predicting winners, it's about avoiding traps. This distinction matters. Defensive positioning often looks conservative, sometimes it looks wrong, until it isn't. Markets can remain elevated longer than expected. Optimism can persist, but structural imbalances don't disappear simply because they're ignored. They resolve eventually. The resolution can take many forms: inflation, stagnation, currency depreciation, financial repression, or outright crisis. Institutions don't need to know which outcome will occur, they only need to know that the range of outcomes has widened. When that happens, concentration becomes risk, diversification becomes strategy. This is why institutional behavior is so instructive, not because it predicts timing, but because it reveals perception. When multiple institutions independently adjust in similar ways, it suggests their models are identifying common pressures. Those pressures may take years to fully materialize, but once recognized, they rarely reverse quickly. That's what makes early awareness valuable, not for speculation, for preparation. Pressures beneath the surface. To understand why institutions are repositioning, you have to examine the forces shaping the system, not headlines, but structure. Several long-term pressures are now interacting in ways that reduce margin for error. The first is sovereign debt. Debt itself is not inherently dangerous. What matters is growth rate. When debt grows faster than the economy that services it, interest obligations expand. Over time, servicing costs consume a larger share of public revenue. This reduces flexibility. Governments facing this dynamic have limited choices. They can impose austerity, raise taxes, or allow inflation to erode real debt value. Historically, inflation is the most common response. The second pressure involves currency dynamics. For decades, global trade relied heavily on a single settlement currency. That created consistent demand and supported large capital inflows. As trade becomes more multipolar, settlement practices diversify. This doesn't eliminate a dominant currency overnight, but it gradually alters demand patterns. Reduced automatic demand changes the calculus for asset allocation. The third pressure is demographic. Economic growth depends on labor force participation and productivity. Aging populations reduce growth potential, younger populations increase it. Capital flows toward growth. This has always been true. The fourth pressure involves policy constraints. Central banks are often tasked with competing objectives: controlling inflation, supporting employment, stabilizing debt markets, and maintaining currency credibility. These objectives are not always compatible. When policy tools become constrained, uncertainty increases. None of these pressures alone guarantees crisis, but together they increase fragility. Institutions respond to fragility by reducing concentration. They increase exposure to real assets. They diversify geographically. They maintain liquidity. They reduce leverage. These actions don't reflect fear, they reflect discipline. For individuals and business owners, the implication is not to mimic institutional portfolios exactly, but to understand the logic behind them. Concentration feels safe until it isn't. Resilience is built before it's needed. Those who recognize structural shifts early retain agency. Those who wait for clarity often lose it. History doesn't punish optimism, it punishes unpreparedness. And every major transition has rewarded those who adjusted before consensus formed. The choice is never obvious in the moment, but the pattern is always there for those willing to look. For most of the modern era, the dollar was more than a national medium of exchange. It was the backbone of global trade. International commerce didn't just tolerate the dollar, it depended on it. Nations held dollar reserves not by preference but by necessity. Central banks accumulated U.S. treasuries as foundational assets. Energy, commodities, and cross-border contracts were priced overwhelmingly in dollars. That system created something extraordinary: automatic demand. Because the world needed dollars to function, the United States could import more than it exported, borrow more than it saved, and finance deficits at interest rates far lower than normal economic logic would allow. Reserve status wasn't symbolic, it was leverage. It functioned as an economic multiplier, one that reduced borrowing costs, stabilized demand for U.S. assets, and supported decades of financial dominance. But systems built on trust don't collapse suddenly, they evolve quietly. And beginning in the early 2020s, that evolution became measurable. Major economies began settling trade without touching the dollar. China and Brazil agreed to conduct bilateral trade directly in yuan. India and Russia moved energy transactions into local currencies. Saudi Arabia, long the anchor of dollar-based oil pricing, signaled openness to accepting yuan in energy sales. At the same time, the BRICS bloc, Brazil, Russia, India, China, and South Africa, representing nearly half the global population and over a third of global economic output, announced parallel financial infrastructure, new payment rails designed specifically to operate outside dollar clearing systems. By the end of 2024, more than one-fifth of global oil transactions were being settled in non-dollar currencies. Just 4 years ago, that figure barely registered. This wasn't a symbolic protest, it was a functional shift. And institutions that operate on long time horizons noticed immediately. When demand weakens, everything downstream changes. Reduced reliance on the dollar for trade has a predictable consequence: less structural demand for dollar reserves. Less demand for reserves means less need to hold dollar-denominated assets. That includes U.S. treasuries. And when global buyers step back from treasuries, the implications cascade: higher borrowing costs, weaker capital inflows, and less external funding for deficits that have become routine. This isn't speculative, it's visible in the data. China's treasury holdings peaked above $1 trillion a decade ago. Today, they are hundreds of billions lower. Japan, still the largest foreign holder, has reduced exposures substantially in just the last 2 years. Saudi Arabia, Belgium, Switzerland, each has trimmed positions. No single country is exiting dramatically, but collectively central banks are rebalancing, slowly, methodically, persistently. That's exactly how institutions behave when probabilities shift. The demographic math that capital can't ignore. Long-term economic growth rests on 2 pillars: how many people work and how productive they are. The United States faces pressure on both. Birth rates have declined for decades. Workforce growth has slowed to levels not seen since the early 20th century. Actuarial projections show fewer workers supporting more retirees over the coming decade, increasing fiscal strain. At the same time, productivity growth has cooled. The rapid gains at the late 20th century have given way to more modest advances. Combined, these trends point towards slower structural growth. Now compare that with emerging economies. India's population is young and expanding. Southeast Asian nations are entering peak productive years. Infrastructure investment, education gains, and technology adoption are accelerating output per worker. From a purely mathematical standpoint, capital flows towards growth. It always has. Institutions that evaluate returns over 20 and 30-year horizons cannot ignore demographic momentum. Over time, it dominates. The policy dilemma with no clean exit. Monetary authorities now face a narrowing set of options. Raising interest rates helps control inflation, but dramatically increases the cost of servicing national debt. Each incremental rise compounds deficits, requiring more borrowing and placing upward pressure on rates. Holding rates low reduces debt stress, but risks eroding currency value. Inflation weakens purchasing power, discourages foreign holders, and can trigger capital outflows. Either direction carries risk. History offers precedent. Britain faced a similar bind decades ago. Attempts to balance growth, inflation, and currency stability ultimately failed. The pound lost its reserve status, not through collapse, but through gradual erosion. This is the context institutional models evaluate, not headlines, but constraints. Why capital moves before consensus? When four forces converge, debt expansion, currency diversification, demographic disadvantage, and limited policy flexibility, risk profiles change. Not certainty, probability. For an institution managing trillions, probability is sufficient. That's why capital moves quietly, not in reaction to panic, but in anticipation of asymmetry, where downside risk outweighs potential reward. Reducing exposure is not abandonment, it's concentration management. The individual problem most people don't see. Consider the typical business owner or professional. Years of disciplined effort have built wealth concentrated in familiar places: domestic real estate, retirement accounts invested in U.S. markets, and cash held in dollar-based institutions. By conventional standards, everything was done correctly. But few ever ask a crucial question: how much of this survives if the currency loses meaningful purchasing power? The answer is uncomfortable. Real estate prices are denominated in dollars. Investment accounts hold dollar-priced assets. Cash is pure currency exposure. If the dollar weakens significantly, all three are affected simultaneously. This isn't theoretical, it's arithmetic. The institutional playbook simplified. Large institutions don't rely on prediction, they rely on preparation. Their responses are consistent. Geographic diversification, not abandoning domestic assets, but reducing over-reliance. Hard asset exposure, assets that exist outside any single monetary system. Revenue flexibility, businesses that earn in multiple currencies retain options. Conservative leverage, less vulnerability to rate volatility. Liquidity preservation, mobility matters during transitions. None of this is dramatic. All of it is deliberate. Timing is the real advantage. Historically, institutional reallocation precedes broader market consequences by 1 to 2 years. That window isn't for panic, it's for assessment. Review exposure, adjust gradually, reduce concentration. The mistake is waiting for validation from mainstream narratives, which always arrive late. The pattern is visible. Institutions don't move trillions without cause. The reasons aren't secret. The data is public. The logic is consistent. Economic transitions don't punish optimism. They punish complacency. Those who recognize structural change early don't just preserve capital, they retain choice. And in every historical cycle, choice has been the most valuable asset of all.